So thanks for joining us, Paul. We're going to do a fireside chat format for this first presentation. Actually, the first two presentations of the 5 companies in this session will use that format, and then we'll switch over to the mic here. So Paul has, I'll just touch on his bio a little bit here. Very impressive. He was appointed CEO and President and CEO of Centerra in May 2023. But prior to that, he was EVP and Chief Technical Officer at Kinross, where he worked for 14 years in a series of progressive roles. And prior to that, I see some management consulting experience and so on. So a broad background to bring into this Centerra role. So Paul, here we are. We're in the first of the afternoon session. I think that because you're the first one, you're just on the cusp of being moved into the earlier sessions with the larger cap. So maybe next year, that's a sign, I think, that the stock is ready to climb. But with that, Centerra released a new strategy in September 2023. Could you update us on the progress that you've made on that strategy so far and how it's going?
Well, it's interesting you say we should be in the morning session with a higher valuation, and that's exactly what the strategy is about. We trade very cheaply on public metrics, 0.5, 0.55 times, on our own internal numbers at 0.4. And there's reasons for that. We'll get to that. But the backbone of strategy at Centerra is to essentially show that there is value in our assets. I think the history of Centerra had some confusion around the role of each of the assets in the portfolio, the molybdenum assets, the ChemS asset in North BC, even Mount Milligan, questions around how they fit in the portfolio. And we set out with a strategy a year and a half ago where we saw that there's enough in the portfolio. We don't necessarily need to do an M&A. There's plenty of metal in the ground. And the strategy revolves around daylighting, surfacing value in the assets. So number one, Öksüt was shut down. Some of you may recall it to an environmental exceedance. Since we reopened it in 2023, it has generated nearly $500 million of cash flow, and it continues to operate, and it's got another 5 years of mine life. Mount Milligan is a copper-gold porphyry in British Columbia with the potential for decades of mine life. We came to an excellent deal with our partner Royal Gold with an amended stream arrangement that provides a greater incentive for Centerra to invest time, study, drilling in looking at a mine life extension. So really there was about coming up with an amended stream that was positive for Royal Gold, positive for Centerra, that created the conditions for investment to extend the mine life, and I'm sure we'll get into a little bit more on Mount Milligan. In the case of molybdenum, this is the one where our valuation disconnect in large part comes from molybdenum, because here we are at a gold forum talking about molybdenum, and that's been our challenge. That's always the first question. Well, why is Centerra investing in molybdenum? The fact of the matter is these assets are in the portfolio. They were on care and maintenance, costing the company money every year. And in the case of Thompson Creek, it was headed to closure. So in the absence of a positive go-forward decision, we were looking at a negative $300 million NPV on closure, care, and maintenance shutdown. The conditions for molybdenum are very favorable right now, and we've greenlit a project that has a positive $500 million NPV. So the delta to the negative option is $800 million. And we are going forward with the reopening of the Thompson Creek mine. So this is another example of converting an asset that was in the portfolio, not really recognized for its value, and putting forward a positive business case decision. And I'm sure we'll get a little bit more into molybdenum as the conversation proceeds here. And we're doing the same with ChemS and Goldfield. We're taking assets that perhaps weren't well understood and demonstrating that they have significant value to our shareholders, whether it's in gold or in copper or even in the case of molybdenum.
Okay, great. So that gives us an idea of the strategy that you've been working toward and unlocking the value that you have in your pipeline. But it sounds like you've really singled in on that molybdenum as a source of the discount. How do you resolve that then?
Yeah, so let's just talk about some of the numbers on the valuation. Our market cap is $1.4 billion. We have $600 million of cash, which means our enterprise value is $800 million. Consensus analyst value on Mount Milligan alone is $1.5 billion, 1.3 to 1.5 billion. So Mount Milligan almost 2x covers our EV. And then you're getting molybdenum, Goldfield, ChemS, and Öksüt in Turkey for free. So molybdenum, and we think that in this gold bull market environment, it's just easier to invest in companies that don't have the complexity of molybdenum, but that's actually what drives the opportunity here. We recognize that molybdenum is a strange fit in a gold mining company. But we had the assets in the portfolio. Historically, they came with the acquisition of Thompson Creek Metals, which is how Mount Milligan came into the portfolio. But the point is, they're in the portfolio. We are looking to monetize those. So our plan forward here is to reopen the mine, and we're well into the project now. We're about $50 million into a $400 million capital program. And as we get close to production, which we anticipate in the middle of 2027, we are looking to monetize the molybdenum assets. And once the CapEx has been spent, in 2027, those assets will be worth $1 billion. And we believe that at that point, or even perhaps before then, there will be the opportunity for an exit in whole or in part, whether through an outright sale, an IPO, a spin, or some sort of strategic outcome on the molybdenum assets. And we ultimately believe that that is the greatest path to value demonstration on molybdenum is through an exit. But to get to an exit, we have to get it up and running and show a positive case.
Okay, that makes sense, and good to hear you're executing on that. You mentioned Mount Milligan. Maybe we could just shift to Mount Milligan for a second here. There's a study that evaluates the future potential of this mine. Could you just talk about how what that study envisions and how that's going?
So let me begin with the description of what Mount Milligan is. It's a very large copper-gold porphyry mineralized system in British Columbia. The asset has the stream on it from Royal Gold, which is an outcome of Royal Gold, in effect, financed the project back in the early days, and so that's the agreement that was in place. Lisa, if you can pull up the cross-section, it's a very large system. We've got the reserve pit. The current reserve at Mount Milligan takes us out to 2036, so we have 10 years of mine life. But that is limited only by tailings capacity. You can see on the cross-section, the next pit shell over is the resource shell. We have another 10 years of measured and indicated. We don't need to do any more drilling. It's delineated, identified. We have a mine plan for it. We just need to identify tailings capacity. We are in the middle of a project study right now that looks at designing, permitting, building a new tailings dam. We're also looking at throughput expansions. And the progress on this study has been better than planned. And we recently upgraded the caliber of that study from a PEA to a full PFS. So it is our intent in September to put out a revised reserve on Mount Milligan. And we expect we're going to have mine life out to the 2040s, and that will include a throughput increase. The way we look at Mount Milligan is in 3 decades. 1 decade of reserve, plus minus another decade of project mine life that comes from the drilled inventory at M&I level. And then looking to the west and to the south, there's significant continuity in mineralization. We are investing a lot of money in exploration drilling along both a west and a southwest axis, and we continue to see holes terminating in grade. We continue to fill in saddles that were previously not drilled but are proving to be mineralized, and we expect there to be yet a further mine life extension. So we have an objective of ultimately delivering a 30-year mine life at Mount Milligan through that combination of the 10-year reserve, the project to add another decade, and then a further decade from exploration. So that's our cornerstone asset. It's what is the key asset in Centerra. The other thing that we're doing at Mount Milligan is we've been investing over the last year and a half in performance optimization, in improving our health and safety metrics, improving our operating metrics, improving metallurgical recoveries, doing a better job of mine to mill, understanding the resource model, what we're sending to the mill operating parameters, say on flotation time, reagent dosing, power to the mills. So we're looking at an optimized system. So in addition to looking at a longer mine life at Mount Milligan, we're also looking at optimizing that which we have.
Okay, thank you for that. Well, moving through your portfolio then, next up, let's talk about Öksüt. And if we look at the reserves suggest a mine life that might extend out to 2029 or so. Is there any opportunity, as there is with Mount Milligan, to extend Öksüt's mine life, or perhaps even other opportunities in Turkey?
So we like Turkey as an operating jurisdiction. The skill levels are good. The geology is phenomenal. You have almost any kind of geologic deposit in Turkey. The grades are phenomenal. So we like the country. As I said, it's a skilled workforce, and there's good line of sight on permitting. We'd love to do more in Turkey. It's a great place to operate. Öksüt itself is likely limited to that 2029 mine life with maybe 1 or 2 years of residual leaching, but we are active on 4 or 5 greenfields projects throughout the country. And as I said, it's really a play on a very attractive geologic setting. So we are investing in exploration.
Okay. So continuing with Öksüt, the production guidance is lower this year than last year, and the costs are higher. So can you explain the dynamic that's going on at this point in the mine life that's driving that?
That's a good question, and that's something that we get at a high level. People see, oh, well, Öksüt's going from 200,000 ounces a year in 2024 to just over 100,000 ounces a year in 2025. And of course, with the denominator impact, the AISC is going up. That's really an artifact of the fact that 2024 was an artificially high year because the mine had been previously shut down. So we were drawing down high-grade inventories in the heaps. So we had an artificially elevated production year, and that's what generated the large part of the $500 million in cash flow over the last couple of years at Öksüt was a drawdown of those inventories. So we're now resetting into what we expect to be the production profile until 2029, which is in that 100 to 130,000 ounce a year range. And of course, the denominator impact, fewer ounces spread over the costs, is a primary driver of the higher AISC. But in addition to that, we do see high local cost inflation in Turkey over the last couple of years. But it's principally denominator impact and then a little bit of inflation impact.
Okay. Okay, good for that. Then, well, why don't we circle back to molybdenum then? You talked about running a process to divest the asset once the enhancements and it's back into production. Can you tell us what that looks like? What does that involve? Is there a market for these assets out there? And are you talking to potential bidders at this point?
So let me describe what we're doing in molybdenum. And as I said, we come to these gold forums, and here we are talking about molybdenum. And it's almost always the first question that gets asked when we do our one-on-one meetings. The Centerra molybdenum business is composed of 3 assets, 2 mines that were on care and maintenance, Thompson Creek in Idaho and the Endako mine in BC. The Endako mine in BC will remain on care and maintenance. We are reopening the Thompson Creek mine. That mine will provide the world's cleanest source of moly concentrates. Literally, the cleanest moly con on the planet will come from Thompson Creek. The third leg of our molybdenum business in the U.S. is the Langeloth roaster in Pittsburgh. It has been running at reduced capacity for the last 10 years, principally on third-party material, not on Centerra material. And the business case here is to reopen the mine, ship the clean moly con from Thompson Creek to Langeloth, which then allows blending opportunities and to drive profitability at the roaster. Put it all together, we have a $500 million NPV on this project, the combined ramp-up of the mine, and then the ramp-up of capacity utilization at the roaster. Molybdenum is in a favorable part of its cycle from a supply and demand point of view. It is used as an alloying metal for steel, so it goes into performance steel. So applications range from the green energy side, solar, offshore wind, nuclear, to defense and aerospace, which currently is in a very strong upward trend, to significant applications in natural gas and drilling. So molybdenum is basically an alloying metal that improves the characteristics of steel. And just given political dynamics in the United States right now, a so-called Made in America solution, Idaho, Pittsburgh, selling product to American steel mills is an attractive proposition at this time. So that's an overview of our molybdenum business. But as I said earlier, we recognize that molybdenum is not a natural fit in a gold mining company, not least because it drives this valuation discount and this perception that why is Centerra investing money in molybdenum? We're investing money in molybdenum because it is a great way to deliver value to our shareholders. But as I said, and you implied, we are open, and in fact, ultimately we'll look for an exit from the molybdenum business, but we've got to create a vehicle that has a clear value proposition. And we believe that as we get closer to production in 2027, that value will be demonstrated. In some ways, the point of maximum discount is right now when you first start on the capital expenditure, and we expect as we deliver on the stripping and the capital program at Thompson Creek, that value will be evident to potential buyers. So you ask what types of buyers. We've seen interest from private equity. We've seen interest from strategics. And even more recently, you get some nibbles from steel makers in the U.S. who are looking to integrate up or down the value chain.
Okay. Well, certainly a cash flowing asset probably won't be too hard to unload and strengthen your already strong balance sheet. But let's shift to the rest of your portfolio now. You've got a strong pipeline. Maybe you could talk about Kemess and Goldfield. Where are these projects at, and what's the opportunity going forward?
We're particularly excited about Kemess, another copper-gold porphyry similar to Mount Milligan, north of Mount Milligan. It's a past producer. Some of you may remember that Northgate ran that mine. It was put on care and maintenance. And Centerra, 4 or 5 years ago, had a different concept for it. It was really to mine out a block cave. That's not the appropriate scope of works for Kemess. It doesn't have enough payable metal to justify the long development timeline, the significant capex, to develop a block cave. What we've done instead is we've inventoried all the drill data on the property, and this slide shows it. The block cave was over there on the right. We're not doing the block cave project, but we've inventoried a whole bunch of open pittable and more conventional underground resources. And what we are going to start doing now is advancing a project to look at how to develop this. So next month, we're going to be putting out an initial resource on Kemess, and it will be in that 4 to 7 million ounce equivalent range. So that's half copper, half gold. And we're also going to outline a potential scope of works on what that Kemess project would look like. I'll also remind you that having been a past producer, there's a 55,000 ton a day mill, there's a camp, there's an airstrip, there's a power line, there's tailings. So in many ways, it would be a reopening of Kemess. It would be a substantially de-risked project because of the leverage on the existing infrastructure. And the last point I'll make on Kemess, it is the gateway to the highly prospective Toodoggone district, which is north of us. So you'll see a whole bunch of juniors like Thesis, TDG, AMark are all north. And by the way, all of them access their sites through the Kemess airstrip and the Kemess road. So Kemess is the linchpin to that Toodoggone district. So we're very excited about this. And the way we look at this is, again, a 2-decade Mount Milligan high throughput kind of copper gold project.
Okay.
Oh, and Goldfield. I want to touch on Goldfield. So Goldfield is in Nevada. It was an acquisition that probably had some dubious merits at the time that it was done. And in truth, we would have hoped to have found more gold at Goldfield through our drilling program last year. In the event, it did not. It did not pan out. But we still have a 700,000 ounce, 0.7 gram oxide heap leachable resource. And we are looking at ways to bring that into production. Certainly with gold prices above 2,200, that project works. So we're looking at what we can do strategically in Nevada to create maybe a decade of mine life and using Goldfield as a starter project. So look for more information on Goldfield here in the next 6-8 months as we think about how to bring that into production. But like I said, it's 700,000 ounces. It's relatively modest. It would be 70 to 80,000 ounces a year on relatively modest capex.
Okay. Excellent. And so, Paul, I hinted at the balance sheet. Okay, you got $625 million in cash, and which by and large we consider that a fortress balance sheet. But maybe if you could touch on your capital allocation strategy. And in particular, like you've been generating positive free cash flow, but during the Thompson Creek expenditure, will you continue to generate positive free cash flow? And then how do you plan to sort of allocate the cash you have and so on?
Yeah, so as you know, $600 million of cash on the balance sheet on a $1.4 billion market cap. That's the EV calculation I talked about earlier. I think that in some ways contributes to a valuation disconnect because there's an assumption that we're going to go do something undisciplined on the M&A side, and we're not. And I think what I'm trying to illustrate here is that in the portfolio, we have more than enough metal in the ground on our own internal projects, Kemess, Goldfield, Thompson Creek, Mount Milligan expansion. We have attractive opportunities internally. And in fact, when we do look at M&A, we compare everything we might buy at the development stage with what we have internally at Kemess. And I'll tell you, any development stage project doesn't screen as well as Kemess does on our own internal. And what better asset to develop than the one you know yourself? So you asked about ongoing cash flow during the Thompson Creek build. Our cash balance will roughly maintain at $600 million even through the $400 million investment in Thompson Creek. In other words, cash flows from Milligan and Öksüt are going to be, at these commodity prices, more or less going to be able to fund the Thompson Creek build. We're active on a buyback. Last year, we bought back $44 million worth of shares. We paid a $44 million dividend. We are going to keep that up. So we're going to continue to be aggressive on the buyback. We're going to continue to pay the dividend. And ultimately, the cash is what will be used to develop Chemes Goldfield in Milligan, and we won't have to raise capital to develop our internal projects. As I said, we do sometimes look at M&A, but I think if we were to do M&A, it would be more of the bolt-on variety on something that makes sense or adds to the assets in our portfolio.
Okay. And, well, you mentioned M&A there, and so we've got a couple minutes left, but I think maybe we can dive a little deeper into the M&A. I mean, right now you've got a pristine all-North American portfolio. What would you consider with respect to M&A in terms of jurisdiction, size, stage, and whatnot?
Well, as we all know, there was a flurry of activity over the last year on production assets being sold at what I would say are very high valuations. We looked at some of those assets, and ultimately the conclusion was that we weren't ready to pay at the levels at which those transacted. But in terms of M&A focus, we are focused on Canada and the United States. We think we have a good franchise in the United States. The administration currently is friendly towards mining, and there might be an opportunity there. British Columbia is an area of focus for us. As I mentioned earlier, we would look at things in Turkey if the right opportunity came up. And we're also potentially open to a couple of countries in South America where the political risk profile is akin to what we have in Canada and the United States. But really, it would be something that is proximal or synergistic with that which we already have in the portfolio. But I stress again, we don't need to do an M&A. We have more than enough opportunity in the company for decades of mine life at our current assets. And the M&A focus, if there is one, will be things that are complementary to that which we already have.
Okay. Thanks, Paul. Well, we have 1 minute here. I'll tell you what, go ahead.
Why not sell the Turkish operations and concentrate on North America, particularly on base metals like Tomory and Chemes? And it gives you. Sorry. Did you hear that?
The question is, why would we not sell the Öksüt mine in Turkey and concentrate on North America?
And then you're a pure kind of base metal company, and you get a re-rate.
Well, so this is a very interesting question. First of all, what would we get for Öksüt? I mean, it'd be some multiple up to one of what we're going to get anyway from the cash flow from that asset. But fundamentally, what it comes down to is we still position ourselves as a gold mining company. An exit from Öksüt would definitively move us into base metals territory because we'd be two big copper gold porphyries plus a molybdenum mine. That would be a major shift in strategy. We want to remain a gold mining company, and that's why our development projects, Goldfield, Chemes, are gold focused. Now, if somebody were to offer some number greater than one on the cash flows we expect anyway from Öksüt, given the fact that there's not a lot of exploration potential there, yes, we would look at that, but we're not actively marketing that for the reasons that I mentioned.
Okay. Thank you very much, Paul. That's all the time that we have.
Thanks, Don.
Certainly there's a number of catalysts pending over the next 12 months, and we'll just ask the audience and other investors to look to the website for that information.
Perfect. Thank you.
Thanks a lot, Paul.
Appreciate it.
So next I'd like to welcome